Hi, good week to all. This is Calvin here. Welcome to this week of our latest edition, weekly technical outlook on the major stock indices for the week of 10th of January to 14th of January 2022. So, as usual, I'll be covering these five major stock indices across the globe. Definitely the two biggest will be the US, the S&P 500, the NASDAQ 100, followed in the two major stock indices in Asia will be Hong Kong 50, followed by Japan 225, and as well as the European proxy, which is the German 40 indices. So let's take a look at the disclaimer slides first before I jump into the analysis. All right. Okay, so before we start, let's take a look at the momentum analysis across the globe for last week performance. So, as you all know that in the last week of, or the last 2 weeks of 2021, the US market ended with a bang. But however, for the first week of 2022, it actually ended with a whimper. So you see all the four major indices from the S&P, the NASDAQ 100, the Dow Jones, the small cap, the Russell 2000, all recorded a negative performance for last week. And the worst hit was actually the NASDAQ 100. So in my Twitter, where I actually share my commentary on a daily basis, as well as key technical charts to look out for, means key team that could actually be involving. I did highlight that one of the reason or the main reason that actually causes the tech stocks to actually underperform is actually due to this rising yield curve, the US 10-year Treasury yield, and most importantly is the yield spread between the 10-year and the 2-year, or we're talking about the 30-year minus the 5-year, that means the long dated minus the short dated, is actually inching upwards steadily since 27 or 26th of December. So that actually supports outperformance of the cyclicals, where it's actually heavily weighted in the Dow Jones Industrial Average. So that actually explains why the Dow Jones Industrial Average actually outperformed with a minor loss against the rest. And the worst hit was actually definitely those tech or growth stocks that have very weak balance sheet, such as those component stocks that are inside this ARK Innovation ETF. So those are also highlighted in my Twitter feed as well. So then I share with you all how to actually follow me on Twitter, that where you're able to get a dose of a key daily commentary and as well key charts to watch on a daily basis. So most important I want to highlight is that the top or the starkly outperformer, but to us it's not surprise why, on the which is the Hang Seng Index, which is 0.41%. Why? Because Hang Seng Index has been flirting, or I would say that retested key long-term circular support at the 23,000 level, and it has a 3 weekly consecutive close above it. So that actually supports our view for a potential, at least a tactical rebound. In we talk about multi-week rebound from this level itself. So it seems to me that there is some rotation back into uh, indexes that are performing badly in the last 3 to 6 months versus indices that actually outperform. A bit of rotation here and there. So not too bad on the German DAX index, ended the week with my modest gain of 0.4%. All right, so if you look at the Hang Seng Index, if I take the difference between last week performance and its prior 4 week average, it actually yield the highest value among the major indices right now, okay, at 0.79%. Okay, so later I'll take a closer look into the chart of the Hang Seng Index to explain the rationale why there could be a potential tactical rebound that is actually unfolding right now for the Hong Kong Hang Seng Index, or the Hong Kong 50, we call it in our platform. Okay, so before we actually jump into this conclusion, that is it game over for the SPX 500, where we see last week is kind of a weekly, kind of a very weak, relatively weak performance. Is I like to measure the kind of this VIX index over here, which actually take into account of this movement itself, where we start to see, we call it a very high VIX movement implies that we are in a stage of we call it very fearful. A very low VIX level, which is around at the 14.2, based on historically this level here, 14.2, is where people are getting very complacent. Means people are getting very greedy or too risk loving, where there could be a risk of a multi-week corrective decline. Yeah, so if you see last week, yeah, there's only last week we start to see a 1 week of decline so far, as compared to the last 4 weeks or so. Will it start to lead to a multi-week corrective decline from here. So the answer to answer that is I overlay with the VIX index. It seems to me that in fact the price of VIX also came down as well instead of going up. So market is not actually quite fearful. It's actually trading between this range of 32 and 14.2. So still got a bit of room to go down to hit this competency level of 14.2, which means, i.e., market hasn't reached, or the S&P 500 hasn't reached a state of extreme, we call it risk loving, where there could actually be, what you call it, a kickstart a multi-week corrective decline. That means what we could see right now is that potentially the S&P 500 could be a sideways, more like a sideways kind of formation towards moderately bullish at this point in time from here. Because yes, even though the SPX 500 overall it consists of 500 companies, but it's still heavily tilted towards growth technology stocks, which may continue to see a bit of challenge from this ongoing rising rising yield curve. So if you could see over here, oops, let me skip it from here. What I could highlight is I want to highlight, right, is the sector rotation. Okay, let me jump. Yeah, this is the sector rotation. Okay, so this is the sector rotation of last week. So what we could see is that yes, even though the SPX 500 has a weak performance last week, but not all sectors are in the red. In fact, the top performing sector, like I mentioned earlier, will be the cyclicals and value, where you see energy actually up 10% and financials quite decent as well, 5.36%. And don't forget, this week we have officially, kind of unofficially, I would say, kickstart the Q4 earnings release season for US stock market, which actually on Friday several key US financial and banks will actually kickstart their Q4 earnings. So what we could see over here is that momentum has started to build up in these financials. So I actually highlighted one, JP Morgan, to watch, which is the chart of my week. So all this can be found in my social media Twitter feed, where actually I tweeted out all this commentary. Okay, so very quickly, right, also a particular defensive also outperforming minorly with a gain of 0.38. So as I mentioned, the worst hit was the information technology, followed by the real estate over here due to this rising yield curve, rising long-dated treasury yield that actually has a direct correlation with the performance of the growth stocks, which is info technology, and real estate definitely is due to competition with their more or less stable dividend yield from their REITs itself. Okay, so now let's quickly jump into the technical chart of the various stock indices that I'd like to cover. So keeping in mind, right, over here is that on the this is the daily chart of the SPX 500. So what I could see on the daily chart of SPX 500 here, previously, right, we still expecting a kind of a residual push up towards to complete the bracket 5 of a Roman 5 in terms of Elliott wave perspective. That means what we could see over here is a 1, 2, 3, 4, 5 and a big 5 structure to actually end. Okay, two ways. It's actually end the major uptrend from March 2020 low, where we could see about a 30% correction, or a potential move to end a 13-year uptrend, which is actually this long-term secular uptrend that is in place since March 2009 low. That was actually the great financial crisis low. So that if that really happened, that means we're talking about a Romatic wave 5, the V shape, the big V, the big V5 over here, the Roman 5. That means we could actually see twice of the decline, which is a 60% decline, to actually retrace this entire 13-year uptrend. So until that actually happened, once we hit this level over here, then we could actually be more observant of the various sector movement in terms of the other, we call it intermarket correlation, like oil and dollar at that point in time, see how it performed. But nevertheless, if you look at the daily chart over here, since the low of 1st of October, it seems to me that right now it's actually start to evolve also a kind of a bearish, we call it a topping formation. We call it a impending bearish ascending wedge, which could actually be implied that we are now in the midst of doing that bracket 5 of Roman 5. Okay, that's a big risk. There's still going on. So I keep that as a risk in my mind. But nevertheless, from a shorter term perspective, right, it's bullish. That means we're talking about from here, because it hasn't ended the fractal analysis, it could still have room to move up or churn higher in the coming weeks potentially. Last week, it managed to help above this 50-day moving average, and as well as our key we call it medium-term pivotal support at 4609. So very quickly, let's go to the the daily chart over here, or the 4-hour chart, pardon me, where's our strategy. So recall that 468 was our key medium-term pivotal support that we have last week. So price action seems to be hovering around above this level. We also correspond to the lower boundary of this potential impending bearish ascending wedge configuration. And right now, we start to see in the shorter term, the 4-hour RSI has started to shape a bullish divergence at its extreme oversold region. So indicating to us that last week decline was a bit overstretched, where we could see at least what you call it, a recovery this week. Okay, so to play this potential recovery, I have an upside, a kind of a reinforce or what you call it, a trigger level, which is at 4750. So a break above 4760 should take us up to another fresh all-time high at 4830 slash 4860, which is a confluence of a Fibo expansion level, Fibo expansion cluster level, pardon me, as well as the upper boundary of this bearish ascending wedge configuration. Okay, so still remaining bullish on the S&P 500, but nevertheless, we are now kind of there's a risk that we are now unfolding within a kind of a longer term major kind of a bearish configuration that is actually starts to take shape on the S&P 500. Okay, now how about the NASDAQ? Okay, so the NASDAQ 100 over here, if we could go to the daily chart, so what we could see here is now being a sandwich again in this big sideways range between its all-time high of 16,770, which is printed on 22nd of November, and as well as the low of 21st of December, which is around 15,500 level, and still holding above the 200-day moving average. So it's more like a sideways configuration right now. And last week, actually, it actually fall past to it broke our Titan pivotal support and fall straight towards the lower boundary of this sideways configuration, which is close about 4 weeks. Not 4 weeks, in fact, 8 weeks. Okay, 8 weeks. And what we could see now is the daily RSI starts to actually shape a turn at this key corresponding support at the 40% level and the 30% level, which is a 40% and a 40% and a 34%. Okay, this zone over here, where if you look at in the past, on 30th of October, it managed to actually see a potential bullish reversal. Similar on the 5th of March, on the 12th of May, and as well as 4th of October. So it actually reached this level again last week. So potentially we could start to see at least a multi-week rebound back in towards the upper boundary of this sideways range. Okay. So as for our weekly strategy for this week, right, since it's now coming already reached the lower boundary of this 8 weeks of range bound configuration, which is the key support level at 15,500. And if you zoom into the 4-hour chart, which is the short-term chart, its short-term momentum starts to showing positive signal as well by this bullish divergence on the 4-hour RSI. So indicating to us that last week fall also a bit overstretched, and momentum starts to actually downside momentum start to get overstretched, and which in turn could actually at least see a potential recovery towards the upper bound, towards the top part of this of 8 weeks of sideways range configuration. So what we have over here is that we want to be too aggressive to say that it will hit the all-time high again soon, but at least a break above 15,920 should take us potentially towards 16,150. Then thereafter, retesting the upper boundary of this sideways range, which is close at 16,570 right now. All right. And also, however, a 4-hour close below 15,500 will actually start to see an extension of this corrective down move towards 15,300, then thereafter followed by 15,010. So what's 15,010 is actually the former swing high of 7th of October. And if I were to draw a Fibo retracement, taking the last, we call it the last prior up move up, is actually 76.4%. And this 1510, if this 1510 is also the 200-day moving average. Okay, slightly at the 200-day moving average as well. So yes, definitely 4-hour close below 15,500 should see an extension of this corrective decline to set sight on this 15,010 level, which is also the 200-day moving average. Now moving on to Hong Kong. So this one I touched about Hong Kong is what's so interesting over here is Hong Kong last week have a neutrality range between 23,800 and 22,660. But this week we turn bullish. Why? Because there are a couple of positive elements that has starts to actually occur in this Hang Seng Index or the Hong Kong 50 Index that we call it in our platform. So let's look at the longer term chart first, which is the weekly chart. So why this 23,000 is very important? It managed to actually held above this level after a test of it in the last 3 weeks, because it's actually a long-term circular ascending trend line right from the great financial crisis low, which is October 2008. And I want to see how the price actually react off this level in the last couple of 3 weeks. So what we could see over here is that it start to form bullish candlestick formation, which is we call it a bullish hammer for 3 consecutive weeks. 1, 2, 3. And what's important is that every time it has an intraday test below it, but it managed to actually have a weekly close above 23,000 level, and with the couple with the 3 consecutive formation of this bullish hammer, as well as this bullish divergence that was actually seen on the weekly RSI as well. So giving us a kind of hint that there's a high probability that this down move, this last down move from 24th of October all the way down to 19th of December low has more or less been pretty much overstretched, and downside momentum has started to lose strength, where we could potentially see at least a kind of a multi-week tactical rebound in the first step. So that being said, over here is that for this week, I will use the low, the which is the 20th of December low, uh, the intraday low, because I do not want to cut it to 23,000 so tight, because just in case of whipsaw. So 22,660 will be my key medium-term pivotal support. If you look at over here, is that the 4-hour RSI right now has really been breaking above its upside trigger, is what we call significant resistance as well, which is at the 63% level. So this level is actually correspond to perhaps very close to the 23,800 price level. So bear in mind that RSI is actually a derivative of price action. Being a derivative of price action, that means we talk about something like a rate of change. I would say it's a modified rate of change. Anything that is a derivative of pure price action has a leading element to it, mathematically and statistically. So given it has this leading element to it, that means what you could see that the RSI has really broke up its parallel significant 63% former resistance, indicating to us there's a high chance that it could actually break up 23,800. So that's why with the aforementioned, we call it a current bullish element, I've actually decided to actually turn bullish for this week on the Hong Kong 50. Nevertheless, it must hold this 22,660 level. If it has a daily close below 22,660, all bets are off. There we could see another slide to retest the next support level, which is a Fibo expansion cluster level at 22,100 slash 21,700. So a breakout above 23,800 may start to see further upside towards 24,440. Then above this level, which is the close to this former swing low of 10th of November and the swing high area of 13th of December, a break above 24,450 should take us potentially higher towards 25,200. So what's 25,200? Is actually this descending trendline resistance that is drawn from the high of 11th of August, and as well as 76.4% retracement of this last or we call it the intermediate down move to 24th, or the intermediate the prior drop from 24th of 2022 of October high to the low of 20th of December. Okay, close to 76.4%. Okay. Okay, so with that, we are actually turning bullish on this Hong Kong 50 index. Okay, so now the next Asia indices like share will be the Nikkei 225 or the Japan 225. Still recall that in the Japan 225 for last week, we actually turned bearish to actually play this push down within this symmetrical triangle range configuration that is in place since 14th of September high, back towards close towards this 27,500 level, and now price action is coming very close to this level already. So with that, let's look at the 4-hour chart. So last week we were here, so we are looking for a push down to actually retest this 27,800 level. So being that it's very close to this level over here, we will actually now flip back to a bullish stance, holding above definitely 27,800 will be my key medium term pivotal support I set for this week. which is the lower boundary of this close to about 3 months plus of a symmetrical triangle sideways range configuration. And if you look at the 4-hour RSI, also has starts to exit out from its oversold region. Okay, so indicating to us some kind of revival of short-term upside momentum. So definitely we need to have a break above the upper boundary of this symmetrical triangle range configuration. So looking for a first step push up to retest the upper boundary of this symmetrical triangle range configuration, 29,360. So we need to have a breakout above this level. So at least a 4-hour close above 23,360 to actually validate exit out of this symmetrical triangle range configuration to test the next intermediate resistance, which is the this 4th of November and 16th of November swing high area at 29,955 level. But we start to see a 4-hour close below 26,800, then we start to see a bit of excess move towards the downside, a breakdown to downside to retest this major we call it sideways range configuration that is in place since August low last year, which is at 27,000 level slash 26,880 level. So now, moving up next will be the European proxy, which is the German 40 index. So if we call that German 40 index, we are looking for a push up to actually retest the current all-time high level that is close to 16,300, which has been almost met, I would say. So I think last week printed a high of 16,285 before it did a bit of pullback. But this pullback managed to help right above, slightly above the 200-day moving average, which is also the former swing high area of 13th of December and 15th of December, now acting as a support at 15,600. And right now, the RSI is actually resting close to a significant ascending trendline support that is around at the 53% level. So moving on to the 4-hour chart, if you look at the 4-hour, the short-term chart over here is yeah, very clearly, it's much more clear on the 4-hour RSI. Managed to bounce off from this significant ascending trendline support, which is acting as a support right now at around 45% level on the shorter term. So what we could see over here is that the price action managed to help pretty close to a significant short-term support level at 15,840, which is the former swing high of 8th of December, tested on the 30th of December, held, and tested on the 7th of Jan as well. I managed to do a little bit of a bounce from here. So definitely this is a key short-term support level. But what I did over here is that I don't want to time it so tightly. I will actually use 15,600 as my key medium-term pivotal support. Why? Because 15,600 is also the 200-day moving average. And if you were to look at the Fibo retracement, if you look at the from last week push up of 20th of December low all the way up to a prior week to all the way up to 6th of January high, what we could see here is the close to the 50% retracement. Okay, so I will use this as 15,600 as my key medium-term pivotal support to actually maintain this bullish bias to for it to retest the current all-time high area at 16,300 slash 16,370, and above it should see further potential upside for new all-time highs at 16,590, which is the 1.618 Fibo projection taken from the low of 30th of November to the high of 8th of December projected from 20th of December, which gives us this 1.618% Fibo Nanchi expansion level, which is at 16,590. So looking for a push up towards 16,590 in this potential coming week. But however, a 4-hour close below 15,600, then we will start to see another round of messy sideways consolidation again for it to actually dip down to actually retest this 6th of October and 30th of November swing low area at 14,920 slash 14,800 level. All right. So with that in mind, this week itself, we start to see most of the indices are actually having this bullish configuration. Yes, even though the weakest one is the NASDAQ 100, but we also start to see NASDAQ 100 in the shorter term momentum has start to get on the better side, which is start to improve, where we could actually turn bullish to play at least up towards close the upper boundary of this we call it two 8 weeks plus of subway range since it's all tough late November all time high. Then before we go over here, is that I want to share with you all, this will be my Twitter feed on my Twitter. So you could actually open up a Twitter account, it's free. Then you could follow me at Kelvin SC Wong. So once you follow me, you actually there's a notification. You turn on the notification. So whatever tweet that I tweeted out every day will be actually you'll be able to get that live notification. So this is the chart of the week that I'll be watching for this week, which is JP Morgan. Also, I always start the morning session around 8:30 with a string of key things to actually or key news and event that's actually happening in the marketplace. All right, and I do explain my view also of what is going on as well. So do give my Twitter feed a follow to get a bit of color of what's going on in the global market space. Okay, so with that, have a great trading week ahead, and I see you all again in my next video.